Welcome to the IDU Career Center. We have a distinguished guest today. We have here Ms. Elizabeth Luna. She is the director of the Aria Wealth Management Group, and she will be talking about Investing 101. So without further ado, let me present to you Elizabeth here. Thank you.
Hi everyone. Thank you, Grace. Thank you for inviting me today. I appreciate your time. Today's segment, we're going to go over Investing Basics 101. I have here with me as well, Lawrence Pizzella, who is my partner. And we are both from Aria Wealth Management. So without further ado, let me start the webinar. Grace, if you've given me share access?
Yes, you can share.
Perfect. Thank you so much. Just give me 1 second while I work out these kinks. It's always a chore to do the sharing here. Just want to make sure you guys are seeing the correct screen. Perfect. Okay. And now one more thing. Larry, can you thumbs up me that you're seeing the regular slide deck and not my presenter view?
Oh, there we go. I see it.
Okay, just the regular screen, not my presenter view, correct?
Yes.
Okay.
Correct.
Perfect. Thank you. I appreciate that. Okay, so again, thank you everyone for, thank you, Manasa. Thank you for being here today. My name is Elizabeth Luna. I am a financial advisor with Aria Wealth Management, and with me as well is Lawrence Pizzella, who is my partner. Today's webinar is Investing Basics, and I call it your recipe to investing. So you'll see it's a play on a theme. So what are we going to learn today? You'll learn a little bit about me and about my firm. We'll talk about investing basics, and we'll have some closing thoughts. Again, I'm Elizabeth Luna. I'm a financial advisor and a principal with Aria Wealth Management. And I help people with their money, manage their money, individuals, small businesses. I help families as well organize their finances and address them and manage their assets. Lawrence, who is here, is also a financial advisor and a principal at Aria Wealth Management, and he helps me manage the money for my clients as well. Aria Wealth Management, I wanted to let you know a little bit about our firm and who we are. We are fiduciaries. That means that your best interest always comes first. We have an agnostic approach to choosing investments, which means that we go into the universe of selection of investments and choose the ones that we deem are best suited for you, for our clients. And we don't sell products and we don't earn commissions. What we do is financial planning, investment management, and retirement income and planning for self-employed and small to mid-sized businesses. Why work with us? Well, our purpose is to empower our clients to make the best financial decisions. And what we're doing today, which is financial literacy and education, is also an important part of what we do when we work with our clients. So, investing basics. It seems a little daunting sometimes, but I think we can get through this. I think I have about 20 minutes, so stop me if I'm going a little bit too fast. But overall, I appreciate you taking the time out of your busy schedules here to join us. We're going to go over some of the basics of investing, just very, very basic information. And some of you may be already at different points in your financial journey. So, and as to your knowledge, but regardless of where you are and where you stand or how you feel about your financial acuity, it can be helpful to get a refresher every once in a while. And there may be some specific details that you've forgotten about over time. So finance and investing, invest in yourself. We're all here today because we know that investing is important in order to reach some of your goals later in life. And knowing the importance of investing is pretty universal. In one of BlackRock's recent annual surveys, 74% of the people not currently invested knew that they should have a better outlook if they were currently invested. But why do people know that investing is important? Why don't they do it? Well, quite honestly, the reality is that it seems a little bit daunting and a little bit challenging. And so 61% of the people who are not investing said it's just too difficult to understand. They didn't know where to start or how to drill down once they had the information. And it is a fact, right, that investing can seem confusing. It can lead to a sense of overwhelming. If you guys watch any type of TV news, you hear, reports about stocks and bonds and dividends and ETFs. And what you're hearing about right now, in particular with the Ukraine crisis, is volatility, stock market volatility. And what does that mean? So there's a lot of language involved in here in investing and a lot of jargon. So it can be really tough to decipher what's going on in the investing world. So how we're going to break this down is just to some simple terms and use a cooking analogy. I like to eat. I like a lot of varied food. So I think this would be a really kind of fun way to break down investing for you. So first, you need to know the ingredients, right? The pieces that you're going to work with. Then you need a recipe, right? And then you put it all together and you get cooking. So that's what we're going to go through today. So ingredients, the first part. When you're cooking, you need to be familiar with the spices, the oils, and other ingredients that go into the dish that you're going to make. During the pandemic, it seems like a lot of us picked up cooking and learned how to cook different meals and cuisines. So that I've become a little bit more familiar with different spices and ingredients that I had not been before. So it's kind of similar with investing as well. You need to know what you need to use in order to be successful. So let's get to know some of the building blocks to the investing recipe that you're working with. To begin with, what is saving versus investing? What makes it so different? Why are they entirely two different things for your money? Well, savings, as we know, is short-term. It's like, a basic bowl of rice. It has a low or no chance of losing money, but it also has a low return. But using that same money and investing it instead of saving it, you can grow it and do something different with it. In this case, we have the opposite of just a bowl of rice, and it's a delicious sushi roll. So investing is long-term. You have a higher chance of losing money, but you also have a better chance of a higher return. So savings are good for some things, and you need to know exactly how much you have available. So you need cash and savings for your everyday needs, which is your daily, as well as for your financial safety, which is anywhere between 6 to 24 months. After that, if you have that covered, you can start thinking about building your wealth, right? 1+ years. That's where the investing comes in. For goals more than a year out, and even 20 to 30, 40 years into the future. The returns that investing can offer become more important. So you think of becoming financially independent in life and later in retirement, or even helping to build a future for your children and other family members. The goals in yellow, building wealth, financial freedom, creating a legacy, those are just not achievable just with putting your money into savings. And this is a very timely topic right now, right? Inflation, the silent roadblock to your goals. This is true. $1 saved yesterday is definitely less today. And for any dictionary junkies out there, inflation is a measurement of the changes in prices of goods each year. And we are currently experiencing this in our lives. We've seen inflation really increase over the last several months. But in our graphic here, back in 1950, if you were going to go watch the movie Cinderella and you had $20, you could buy 43 movie tickets. Flash forward to 2020, with that same $20, you could barely buy 2 movie tickets. And you can only get 2 movie tickets if you actually went to the matinee show, not to the regular nighttime show, because I think those are more than $10. So you can really see how the price of admission has increased from 1950 to 2020, and it's ballooned from 46 cents a ticket to $9.16 a ticket. What inflation does is it eats away at the value of your money. So that's why investing is the first step in the fight against the effects of inflation. The greater the difference between how much our money grows and the inflation rate, the lesser impact it has on our overall wealth. So some examples of investing and savings. There's really, we call them asset classes, right? We invest our money in a bunch of different things and they're called assets. And the two most common and basic investment assets are stocks and bonds. And on our investment spectrum, we see that cash, savings accounts, bank CDs have the lowest risk and the lower potential for return. And then bonds have a little bit more, and then stocks are at the highest, as with higher risk and higher potential for return. So let's talk a little bit about stocks versus bonds. Owning these assets gives us the potential of returns greater than inflation, but each one is different, right? The first one, stocks, you may have heard of before, you might be a little bit familiar with. Owning stocks essentially makes you part owner of whatever company you bought stock in. Think of it as owning a piece of the pie. And here we're looking at a graphic of a pizza. You share in the success and growth of the company, often in the form of dividend payments, the company splitting profits with you and increasing share price, making your initial investment more valuable. The second one is bonds, which is a little bit different. Instead of owning a piece of the company, you're basically lending money to them with the promise of the company paying you back in full, plus a little extra for your help, known as interest. So you may think of them as kind of like a student loans, where a bank loans you money and you pay it back with interest. So with stocks, you're an owner. With bonds, you're a loaner. So those are the two basic ingredients at work here. So now let's talk about putting them together in a recipe and how these ingredients work together to give you the results that you hope for. So portfolios and diversification. To put it simply, the key is in creating a diverse portfolio. We have heard this term before, diverse portfolio. We're going to dive a little bit deeper into it, but let's just break it down real quick. A portfolio is just a collection of assets, like stocks and bonds, within an investment account. And diverse refers to that collection consisting of different assets. So not all stocks and not all bonds, or all one of one investment, or all of something else, right? So just like all types of varied foods, right? That's what a diverse portfolio is. You're not eating just the rice every day. You're having, pizza and salads and etc. So that's what a diverse portfolio is. So the recipe really starts with risk and return, balancing your risk and your return. With more return, you also get more risk. Risk, the likelihood of losing money, and return, which is the potential that money might make, are directly correlated. With a higher potential to grow, there's also a high potential to lose as well. Each asset has its own unique risk and return profile. If you think of the assets we've talked about on a spectrum, stocks would have the highest potential returns on the upside, but also the highest potential for losses. And with bonds, though, you may not make as much money as you would by investing in stocks, but you're also less likely to lose as much money than as if you would have invested in stocks. For that reason, any single bond you invest in will almost always be less risky than any single stock. So looking here, we see the average annual returns for asset classes since 1926. Over the course of those years to 2020, cash or savings has yielded about 3.3%. And US bonds, out of 1.1 years out of 10, it's lost money and it's yielded about 5.1%. But of course, with inflation digging in of 2.9. And the US stocks, 2.6 years out of 10, it lost money, but overall yielded a return of 10.4%. So the benefits of diversification. Why is it important to diversify? Well, that's because when different asset classes zig, while others zag. That means that different assets move in different directions from one another. Stocks and bonds, for instance, are typically inversely correlated. If one goes up, the other one will go down. That's because each asset class has their own unique risk and return profiles. By combining different assets with different risk and return profiles in the same portfolio, we can use these to counter movements to help offset the risk of each one and bringing down the total risk within the total portfolio. Diversification is really important because lowering your risk can be essential for the long-term success of a portfolio, even more so than trying to get the highest possible return. As losses mount higher and higher, the return needed just to break even, let alone gain money, becomes exponentially greater. If you lose 5% in your portfolio, the return that you need to break even is 5.3%. But if you keep taking a look, if you lose 50% in your portfolio, you need 100% just to break even. So that's why diversifying your portfolio is so incredibly important, so that you lower your risk. And a balanced portfolio is like a balanced diet, right? So you need a good mix of all the different asset classes in order to have a healthy portfolio. Just like in a balanced diet where you have, a certain amount of fruits and protein, you can't have, all fruits or all protein. If you have a balanced diet, incorporating all the different types of proteins and fruits and grains and vegetables, that will give you a good, healthy mix. And a diversified portfolio can work even though it often doesn't taste very good. This all makes sense on paper, but it's really hard for us as humans to actually stick to it. And we're seeing that right now, in particular with the stock market volatility. It becomes really hard to stick to your cooking, right? Our emotions can get in the way and cause us to go off course, because diversified investing can seem boring and it never really feels like you're getting ahead either. It can be tempting to put your money in an exciting, high-flying stock, especially if you're making less in the market up years and still losing money in the down years. But the chances of successfully picking that one winning stock consistently over the entirety of your life are slim to none, right? That's the reality. That's why sticking to this recipe of diversification in your investments is so, so important. Even though it can seem hopeless in the short term, in the long term, it can have a powerful effect. So make sure that you keep your eye on the long term and not on the short term, because a diversified portfolio will always win in the end. So now that we're familiar with the pieces that go into investing, as well as the plan for using them, let's talk a little bit about how to actually start putting these ingredients all together and put them into action. It's time to get cooking. If you're sitting there saying, okay, I need to be diversified, I get it, with both stocks and bonds. So I should be good by investing in one stock and one bond, right? Oh, well, the answer actually is no. There are really two levels of diversification across asset classes and within asset classes as well. We covered the first across the asset classes, where you want different types of asset classes to offset one another. But in each asset class, there are also thousands of options to choose from. Just think of all the thousands of stocks out there. No one has a crystal ball, so if you pick just one stock, it's impossible to tell if they'll actually make money or end up losing money, which happens often, right? But what you want to do instead is to buy some of every stock out there, so that if some loses money and the rest make money, they help to offset each other, just like with stocks versus bonds. But this can be really expensive for the average investor to do so directly, right? So it would be super expensive for you to go out there and buy all of the stocks in the Standard & Poor's 500, buy 500 stocks. That would be super expensive to do. So the most practical way to do this is by buying mutual funds and exchange traded funds. In this way, mutual funds and ETFs have made investing easier for investors by giving them pre-packaged vehicles, so like pre-packaged meals, so to speak, for investment. Both are similar, but with slight differences. Mainly the ETFs trade on the stock exchange and mutual funds do not. But both are pooled investments that buy a diverse set of stocks, bonds, or a mix of both for their investors in an easy package. So if you were to buy a broad market stock fund and a broad market bond ETF, you would be more naturally diversified across both and within asset classes. And here's how they work. Let's take a hypothetical stock fund. There are more than 5,000 individual stocks to choose from. As I mentioned, this would be hard for someone to do just by themselves. So the fund takes in money from lots of people, allowing it to have a pool of money large enough to buy a lot of stocks. In exchange, they give you shares of that fund, like shares of a stock. The people managing the fund selects which stocks to buy based on their own analysis, typically mutual funds, or based on a set list of stocks based on certain criteria known as an index. Typically, those are in the ETFs. This number is typically at least 20 different stocks that they purchase, and could be as much as all the stocks available, which are over 5,000. Your fund's share value is based on an average value of the underlying stocks that the fund buys. As the majority of those stocks go up and down, so does the average, and so does your fund shares. So what's really important is to people say, I don't know when to start investing. And I always tell people the best day to start investing is today. But I know that that's kind of seems a little bit difficult, but this is why systematic investing is really important. The sooner you start, the less you need to invest each month to reach the same goal. The power is in compounding interest. As you add more and more money over time, the returns of that money will keep compounding off of one another. And the larger the pool gets, the more dollars it translates to each time. If you had 50 years to invest, it would take just $60 a month to retire at 65 with $1 million. So if you were 15, if you had started at 15 years old and you wanted $1 million to retire at age 65, you would just have to invest the $60 a month. But it would only take a total investment of $36,000 to get there over the entire time period. If you compare that to waiting just 10 years to start, so at age 25, that same 1 million would cost $160 a month, and the total would be nearly twice as much. From there, the numbers only get bigger and bigger the longer that you wait. So every day counts. That's why, like I said, whenever people say, should I start investing? When should I start investing? The best answer is to start investing now. We talk about investing monthly because doing so has the potential to help you take better advantage of fluctuations in market prices. This method of investing is called systematic investing or dollar cost averaging. So dollar cost averaging is probably the words that you've heard before. If shares in your investment go down, you're able to buy more shares with the same amount of money that month. If it goes up, yes, you'll buy less shares, but you made money on your existing ones. Let's say you're investing your $60 a month in an investment that starts by costing $60 a share, as shown in the example here. Over the course of this hypothetical year, you would have purchased 14.1 shares for an average price of $51.06 a share. If you had invested the total amount of money all at one time at the beginning of the year, that $720 would have only yielded 12 shares for an average price of $60 a share. By investing all at once, a lump sum, you would have made less of a gain over the year. In this example, you would have had fewer shares owned that would grow in the future. So, we talked about what to invest, what are the investments out there, and why diversification is so important. But let's talk now about where to invest. You can't just, go out there and just think about, there's actually, you need to have an account somewhere to put these investments in. So as I mentioned at the beginning of the presentation, investing is for long-term goals. Luckily, there's a lot of different ways and choices of investment accounts available for you that can be uniquely tailored to suit your specific needs so that you can achieve your goals. And we're going to talk a little bit very quickly about that because we're approaching about 22 minutes about the different type of accounts out there that are available for you to invest. So taxable brokerage accounts, you use those to build wealth. You can contribute as much money as you want after tax. When you take the money out, it's subject to both income and capital gains taxes. And what you're doing is you're building your wealth building overall. The next type of accounts that are available to you as an investor are individual retirement accounts, IRA accounts. There's contributions, a maximum $6,000 a year for traditional or Roth or combination, $7,000 if you're age 50 plus. And this is all subject based to your annual income. Withdrawals, they're taxed on traditional, but not on Roth, and it may affect your income tax bracket. The withdrawals for an IRA, traditional only, are mandatory starting at age 72. And if you take that money out before age 59 and a half, it's subject to an extra 10% penalty. So these are long-term retirement-focused savings due to tax-advantaged growth and potential. There's also other retirement plans out there that are employer-sponsored, and probably a lot of you are familiar with them, with a 401k or a 403b, and for those working in governments sectors as well. The 403b is for nonprofits. Contributions are at a maximum of $19,500 a year and $26,000 if you're age 50 and over. It usually works as an automatic deduction out of your paycheck, and your employer may match your contributions. When you withdraw the money, again, if it's a traditional, you're going to be taxed as you pull the money out. Same rules apply, mandatory at age 72 for a traditional IRA. And if you take your money out before 59 and a half, you're subject to a 10% penalty. So if you have a 401k plan with your employer, make sure that you are contributing to your plan, don't miss out on tax advantage growth, and meet the full match. So make sure that you're contributing as much as you can in order to get the employer match. So we talked a little bit about that. Just another couple ones, 529 plans. Those are great for those of you who have children and you're thinking about saving for college. You're able to really contribute that after tax and grow them tax deferred. There's no limit, and you can use that for qualified expenses up to $10,000, tax-free for K through 12, and of course later for college as well. And there are other options as well. So many different options out there available for you to put your investing assets in. So closing thoughts. I hope that leaves you with a good starting point for investing. And we went through the ingredients that it takes to invest: stocks, bonds, and the inflation. And then we discussed the recipe to follow to get a diversified portfolio. And finally, we talked about how to start cooking by investing in mutual funds or ETFs across different types of accounts, depending on your goals. But if I had to leave you with one thing, it would be this: get started as early as you can and right away. Getting started can often be the hardest part for anyone, but I think there's a lot of resources out there for you to get started. Don't be intimidated. Don't be daunted by this, because it's super important to get started right away and get started towards having a great financial future. So, thank you very much. I think we've reached the end of our time. If you have any questions, feel free to reach out to me. My name is Elizabeth Luna. My firm is Aria Wealth Management. I'm happy to speak with you and help you find the best ingredients to have the most tasty meal of your life. Thank you for your time.
Thank you so much for that wonderful presentation, Elizabeth. So now let's open for question and answer. Thank you. So if anyone has questions, can unmute yourself and ask Elizabeth directly your questions.
So Manasa has a question about HSA accounts. Those are health savings accounts. Yes, those are also available as well, and you can use them for both a retirement feature as well as for its purpose, which is for health savings. The health savings accounts are directly tied to a high deductible health plan with your insurer. So sometimes that can be a little bit limited if you don't choose that option. Especially during enrollment period, usual companies have enrollment periods in October, September, October every year. It's really important to go through your benefits package at that time and choose the right benefits for yourself and review the type of contributions that you're making to your 401k plan as well. What kind of bonds, this is Poonam who's asking a question, what kind of bonds would I recommend? Well, I think that depends on your situation. Usually we would see there's with bonds at this point in time, it's been a little bit difficult because interest rates have been so low, but it would definitely depend on your situation. There's municipal bonds, there's corporate bonds. It depends on if you're looking for tax free growth or interest, or if you're looking for dividends as well. One thing I will do, yes, Leila.
Hey, hi. Thanks for your session. I was just wondering about a couple of things. One, what kind of tax implications are there for any profits that you get from investments like these? And the second is, how do you, as a student, there's not a lot of money you could possibly spare for additional investment. So, what's a good amount to start, and where's a good place to start with?
Sure. Yeah, so tax implications, right? There are tax implications, and it depends on your tax bracket too. But dividends, interest, and capital gains and losses, those will all impact your tax situation. Then again, it's varied. So I don't want to say that one will have more of a taxable implication than another. So it depends on your situation. As to being a student and starting off, I totally understand that. I've got actually 3 children who are just starting their careers. Where to start? Start small with what you can afford. The most important thing when we looked at the beginning of this webinar was to make sure that you have your emergency savings. And once you've got that covered, then you can start investing with whatever amount of money that you're able to or you're willing to put into investments, and do it systematically on a monthly basis. A good broad-based market ETF is good, as well as a bond ETF.
Okay, thank you.
Larry, do you have anything to add about that?
No, like what you said is important. It just doesn't really matter the amount, as long as you just get started. It starts a habit. It could be $100 a month. You do want to have, like Elizabeth said, so a savings though. You don't want to be investing before you have anything in your savings account in case something happens. I think that was important, an important point.
Got it. Thank you.
I am going to pop in my Calendly link here. Feel free to make an appointment with me. It's complimentary. If you want some further advice or you have any questions, I'm always happy to jump on a call with somebody and have a chat. Thank you, Manasa. It's great being here with you guys. Thank you so much for being here and taking your time out. Anything I can do to help you demystify what investing is, Larry and I are both available here for you.
Thank you.
All right. So thank you so much, Elizabeth, for that wonderful talk. And thanks everybody for coming. I think,
my pleasure.
Yeah. Thank you so much.
Great. Okay. Thank you. And everyone have a great day. And I hope to hear from you all.